And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome, of course, to Thursday. It's the second best day of the week following a holiday. And thought I was going to drown yesterday, but made it. Just we're having torrential downpours right now. And it's interesting, you know, right now we're having a lot of heat here in Houston, right? Rain. There's like a whole heat dome over like the southern half of the U.S. Snowed.
Where?
Yesterday, yeah, yesterday up in Jackson Hole, snow.
Really?
In June. So at least they're getting some cool weather. I don't know. Right.
Apparently.
We get heat and rain, so there you go. Anyway, but yeah, so everybody survived yesterday. Fortunately, this was just a good, heavy downpour, and my wife is now the best weather forecaster ever, because whenever she tells me to turn on the water sprinkler, I don't, because the next day it's going to rain. It's just like literally like clockwork. She says, you better turn on the water sprinkler, hasn't rained in a couple of days. Yeah, next day it's going to rain. So just guarantee. So next time she tells me to turn on the sprinkler, I will all let you know that it's going to rain. So get taken care of. All right, yesterday market was closed. So we have absolutely nothing to talk about today. So well, we're going to go through a few things though. You know, first of all, as we've kind of talked about here lately, you know, the whole function of, you know, kind of the economy right now is showing signs of weakness. And one of the things that is the kind of the most concerning right now for the markets, from my perspective, is that analysts are very, very optimistic about earnings and earnings growth over the next year. So not only just into the end of 2024, but into 2025. S&P earnings are now expected to reach $251 a share on a reported basis. That's a very sharp increase. We've talked about this a little bit before. That's about a 20% annualized rate of return in, or sorry, a 20% growth rate in earnings between this year and next year. So it's just very, very sharp. And that's okay as long as you have economic growth to support it, but yet the economic data as of late has not really supported that. One of there's a very interesting correlation between ISM, so the Institute of Supply Management, you know, they're the ones that put out the both manufacturing and services indexes, and those are surveys. But one of the things that they survey is new orders. Now this is important, right? Because what is a new order? A new order is somebody placed a customer placed an order to buy a good product or service, right? So if those orders are going up, that means that companies are having to fill orders, which means they're making revenue. So not surprisingly, this is kind of elementary, if new orders are rising, then earnings should be going up as well, right? There should be a correlation, and there is. There's a very, very high correlation, it's in the 90s, between ISM new orders and earnings. Now, interestingly enough, those ISM new orders had been rising since October of 2022, when we kind of bottomed. Since then, ISM new orders have been rising, and not surprising, earnings have been rising with them. But over the last few reports, there's now been a very sharp downturn in new orders. And that really kind of aligns with this very sharp drop-off that we've seen in economic activity as of late. Retail sales is a good example of that. We just saw that number earlier this week. So right now, earnings estimates are expected to keep going up, but ISM new orders, where there is a very high correlation to earnings, actual earnings, because of what new orders represent, is going down. So again, one of the things that we're looking for later this year is starting to see whether or not this recent bout of economic weakness is just that, just a temporary slowdown. And then it's going to reaccelerate, which is what Goldman Sachs expects. Now, Goldman Sachs is very optimistic. They're expecting a sharp acceleration of economic growth through the end of this year, and that's to support their estimates for earnings growth and their target now of 6,300 for the S&P by the end of this year. So, very optimistic. But we'll see how this works out. We're about to head into really kind of the heat of summer, so to speak, the summer doldrums. Got to get ready for the election coming up in October. So again, a lot of concern right now between two candidates, and they have very different policies regarding trade, immigration, kind of protectionism versus nationalism, etc. We'll see, but taxation, very different policies on both sides. One wants to tax more, one wants to tax less. So how this market reacts to whichever candidate wins the election will be important going forward. Now, historically, as we talked about before, we tend to get a market correction going into the summer. As we get into like September, October, you kind of get a correction heading into the election. That's because you don't know what the outcome of the election is going to be. And then once the election is done, it's like, okay, great. I know what I'm going to get with Joe Biden. I know what I'm going to get with President Trump, and I can position accordingly. So maybe I sell tech and buy utilities, or sell utilities and buy tech, depending on what the views are, right? So that's what's going to come up. Okay, let's talk a little bit about what you need to know before the bell this morning. Little bit of data out this morning, not a lot. We've got housing numbers coming out, of course. National home builder sentiment has been dropping sharply, and particularly in the new home sales area, because those have been fairly weak. Also, initial claims out today. We're going to continue to see initial claims tick up. Again, concerns when it relates back to the Federal Reserve is whether or not unemployment is going to go up, which would get the Fed to cut rates. So everybody's watching initial claims today to see if those are going to be rising to any degree that would suggest that unemployment, or I should say employment, is actually weakening. One of the big dichotomies now, we're covering this in this weekend's newsletter, and we've talked about this over the last week or so, is about market breadth, right? So we've seen the number of stocks trading by their 50-day moving average. Those have been declining, even though the market's been rising. The number of stocks above their 200-day moving average are declining, even though the market is rising. One of the big gaps right now that's going on, and we haven't seen this big of a gap in performance since really the financial crisis back in 2008, is that between the S&P 500 and the equal weight index. So this is RSP, which is the ETF that represents the equal weighted index. And while the broad market continues to make new all-time highs, the S&P equal weight index has not really done much of anything really since April. We had this correction in April, just like happened with the S&P. Since then, has traded fairly flat, because this whole rally since April has been pretty much just a handful of tech stocks that have been going higher. But this isn't just a recent level of underperformance. This really underperformance goes back to October of 2022. There's a very big gap. If you had been invested in the RSP, equal weighted index, you have vastly underperformed the markets by about 50% relative to what the market has returned itself. And that's because of the differential in weightings. The RSP, the equal weighted index, has about a 15% weight in technology, and in the top 10 holdings is not Apple, Nvidia, Microsoft. They don't even show up in the top 10 holdings. Of course, if we take a look at the SPY, which is the market cap weighted index, the top 10 holdings are Apple, Microsoft, Google, Nvidia, the ones that have been driving the market. But the S&P 500 has a 31% weight in technology. So again, since technology has been driving the market, and again, if we just take a look at XLK as an example, so this is the technology index of the market, you can see that since here's April, had that correction, and even though RSP has done nothing because they are underweighted technology, you can see that really the technology index has been doing all the work of lifting the broad market. That 31% weight in the SPY is what's driving those returns. So here's all your activity in the markets. But that deviation between the market cap and the equal weighted index does not last indefinitely. And eventually that performance will reverse. It's just a question of when and what causes it. But that's what you need to know before the bell this morning. We come back, we'll get into our show. Got a few things to talk about this morning. We'll get into that when we come back from the break. RealInvestmentAdvice.com.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will Nvidia go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So a couple of things to kind of talk about. There's been a lot of conversations as of late about the Petro Dollar. And I've seen I've gotten tons of emails about the Saudis abandoning a 50-year agreement with the U.S. over the Petro Dollar, and this spells the end of the dollar, blah, blah, blah. And it's nonsense. And again, this is, typical of a lot of these media channels that are promoting this kind of end of the world doom and gloom scenario, and all in the name of selling you gold, generally. This is where you'll find this stuff. It's like, oh, it's the end of the dollar, you better own gold. And, that's fine. Look, I have nothing against gold. I think, if you own gold in your portfolios, that's great. We have a portfolio that has gold in it. So, it's a commodity. It trades. It's an asset. So if it's an asset and it goes up and down in price, I'll buy it and sell it. So, that's what our jobs are as investors. And all these other things where people are trying to sell you a product, be very careful of that. Because, again, they have a bias to whatever it is that they're selling. I'm a gold dealer, so I'm going to come up with every reason that's in the sun to sell you gold because it's how I make money for my business. If I'm an insurance salesman, I'm going to come up with every reason in the world you should buy insurance, and that's my business, right? I mean, if I'm a realtor, I'm going to come up with every reason in the world you should buy a house that you can't afford, but that's my job, right? So just always keep focused on, what the narrative is and what's the purpose of that narrative. Our narrative is very clear. Our job's to make money. And I don't care what it is. If it's going up or down in price, I'll buy it, short it, sell it, whatever it is. I don't care. I just want to make money. That's our whole job. That's your job as an investor. And so I want, so it's interesting though, there's just been a raft of these articles and videos coming out about the demise of the Petro Dollar and that we need to, this spells the end of it all. Okay. First of all, just again, these reports are rife with accuracies. Let's just begin with the basics. The Saudis have transacted in dollar currencies for decades. And there has never been a formal treaty. There was never an expiration date. It's just kind of a informal handshake arrangement at best. If there was ever actually an arrangement, that's it at best. It's like, hey, we'll transact in dollars. And it's just this very loose arrangement that's out there. And, so even with the fragments of their transactions that they're doing with other currencies, that has more to do with the value of the dollar relative to their currency. And we've talked about this before on the show, more so than some abandoning the US dollar, right? If the dollar's strong, which it is right now, relative to other currencies, then it can behoove me to do a transaction in another currency if it's more beneficial. But at the end of the day, the goal is to keep all currencies within some reasonable bound of each other, right? If somebody's currency is too strong, they have an advantage over other countries. If it's too weak, vice versa. Because if my dollar's too strong, that makes imports cheaper, right? For U.S. citizens. If my dollar's weak, it makes imports more expensive. So what countries do, and they do this through a variety of manners, is to try to keep currencies somewhat in line with other currencies for the sake of trade. How do I do that? Well, one way I do that is for instance, if I'm China and I'm selling a whole lot of goods to the United States, I have a couple of ways to kind of keep my currency more or less somewhere within a bound or a boundary of the US dollar. I can do that by sanitizing trades through buying US treasuries. I sell $1 billion worth of goods to China. Instead of taking that money, $1 billion worth of goods to the US, but instead of taking that money back into China, I buy US treasuries with it. And so I sanitize that trade. If I took all that $1 billion back into the yuan, that would increase the strength of the yuan relative to the US dollar. Another way I can do it is buy gold. So we've seen a lot of gold reserves going up. Why? Because the dollar's been rising. So central banks buy gold to balance their reserves requirements, and that keeps currencies somewhat in line with each other. Again, this all comes down to trade. We had this conversation at length back in 2022. There was a lot of this commentary running around about the death of the dollar, de-dollarization. And we wrote a lot of articles back then. If you go on our website, just type in dollar. You'll find numerous articles we were writing about the fact that that's just not the case. And at that point, the dollar was getting weaker relative to other currencies. And it was like, oh, it's de-dollarization, the dollar's going to zero. Well, the problem is that wasn't the case. And since then, the dollar's gotten stronger. So, that's what it is. But the world transacts in dollars for a simple reason, is that what's your other choice? Mike and I have had this conversation several times with you. If you're doing $1 billion or $2 billion or $5 billion, or you're China, you're doing $50 billion a year in transactions, what currency are you going to use? Are you going to use Zimbabwe dollars, Russian rubles, right? French francs, the euro? What are you going to use? Because you need a currency that is deep and stable to transact that business in. This is the problem with Bitcoin. While Bitcoin has some very interesting aspects to it, it's not good for trade because it's too volatile. It moves 5% in a day, 10% in a day. So if I'm producing a good or a service and Brent and I come to an agreement that I'm going to sell Brent this cup at, $50 because it's a Yeti and they're just stupid expensive. Brent says, okay, great, I'll buy it for you. And I'm going to pay you in Bitcoin. Well, the problem is by the time we execute the transaction, we agree to $50 worth of Bitcoin, but I may wind up with $40 worth of Bitcoin. And now my production cost is $45 for this mug, so now I'm losing money. So I have to have a currency that is liquid and deep and stable in terms of value. And it's not jumping all over the place every day so that we can conduct business and I know what I'm going to get. And here's the other reason why the dollar remains the currency of choice and will remain so that way. Outside of the US, there's no other currency that is near deep enough or liquid enough to handle the transactions that occur on a daily basis around the world. But there's another factor to this, which is safety. And that is the function of, at some point, just like is happening with Russia right now. Russia has currency sitting out in the world. They have reserves sitting out in the world. What's NATO doing right now? NATO's going, yeah, we're just going to seize all of those currency, all those deposits, and we'll use them to help fund the war between Ukraine and Russia. That doesn't happen with the US dollar. The rule of law, although we've done a great job of just eroding, the strength of that rule of law over the last, really since the financial crisis when we undermined contractual law. But we've done a great job of undermining our rule of law. But there's still a rule of law here that exceeds that of the rest of the world at this moment. So in other words, if I do business and something goes wrong, I sell my product to Brent, Brent fails to pay me, I can take him to court in the US and win my case. Most likely, and get paid. So there's legal recourse that is not available in a lot of other countries. A lot of other countries that are dictatorships, etc., you don't necessarily have that legal recourse. The government has the supreme control. So, yes, there are arguments that we could see a broader shift away from the US dollar, particularly if we continue down the path that we're currently on. And it has nothing to do with the debt, it has nothing to do with the deficit. It's about policy choices that we're making here in the US that erodes that underlying rule of law. Weaponizing the legal system is a problem. You may not like your opponent, you may not like what's going on in the world, but using the legal system as a tool of war in that case undermines the very stability of that legal system. So if you continue down that pathway, that is part of that erosion of the rule of law we're talking about. Undermining contractual obligations. So going back to the financial crisis, people had mortgage obligations and we just said, don't worry about it. During the pandemic, we said, don't worry about making your rent payments or paying your student loans, not your problem. Student loan debt, right? The president has been making executive orders to forgive student loan debt that is outside the contractual obligation of the borrowers and the lenders. That undermines that legal system. And the point about this is if I enter into a contract to do business, and I'm transacting in US dollars, all of a sudden I start asking myself is that at some point, is there going to be some executive order or some action by the government that all of a sudden says that contract is no longer valid? That erodes the strength of that rule of law, which is the very cornerstone of the capitalistic system and why the capitalist experiment was so successful over the last 200 years. But right now, we're a long way from that road. So this whole demise of the Petro Dollar, we'll finish up this conversation on the other side of the break, but most of it's myth. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will NVIDIA go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So there's a whole big food discussion going on in our chat channel right now. Brent just weighed in saying can't beat a hot chocolate chip cookie from Chick-fil-A.
The Real Investment Show podcast.
I disagree because at Slotsky's not only can you get a chocolate chip cookie, you can also get a hot Cinnabon.
That's like apples and oranges.
That is not apples and oranges.
It's cookies and buns.
But you could take a Cinnabon and put it between two chocolate chip cookies.
Yeah, well, you can take a Cinnabon and
At realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I had a question in the chat this morning. First of all, yes, I'm reading your chat, so as always. Y'all just normally don't talk about anything important, so. But a couple of good questions this morning. Yes, Michael is on vacation today, so I am solo. And with yesterday being a holiday, there's not a whole lot going on. So probably in a few minutes, we're just going to answer your questions. But there was a good question here talking about, you know, the divergence between oil prices and energy stocks. And there certainly seems to be kind of a gap as of late, particularly in the last few days. Oil prices have been going up over the last couple of weeks, and energy stocks have not really been doing a whole lot. And that you would think there would always be a very high correlation between those two asset classes because oil is the input source for income for oil companies, right? And Brent, can you bring this chart up for me? So this is a chart of the performance of XLE, which is the energy ETF, and which is in red, and the black line, which is West Texas Intermediate crude oil. And as you can see, prior to, really the 2020 crisis, and really coming out of the 2020 crisis, there was a very high correlation between kind of the ebbs and the flows of energy stocks versus oil prices. But since then, oil prices have gotten very deviated. Energy prices have gotten very deviated from oil prices. And that gap, that kind of Jaws looking thing right there, is not really sustainable because, again, the performance of energy stocks is so deviated from the underlying input source of their income, their revenue, which is oil prices, that's problematic. Now, this is a weekly chart, mind you. Okay, so be a little bit, you say, well, oil prices up a lot more the last couple of days. Yes, this is a weekly chart, so just be careful of that. But, this is, and this goes back 20 years. So we can go back and we can see that big spike in oil prices back in 2007, 2008. That was peak oil. That's when we were running out of oil. And then we had the crash. And then at the bottom of the crash in 2009, we started the fracking miracle, and that was where we started producing a bunch of oil again, right? So we've kind of gone through these ebbs and flows, and whenever we've had these events like the economic shutdown, we sent oil prices running higher, and then they eventually correct back down to reality. So, that's just kind of the ebb and flow. But energy stocks, because of this chase, this monetary input that we've had over the last really 3-4 years in particular, which is kind of going along with the whole market itself, these stocks are very deviated from the underlying performance. And so the risk is that over the next, few days or whatever, energy stocks can go up or down, whatever they're going to do. But at some point, that input into their earnings, their bottom line, is not able to support the price performance of energy stocks. But this has been because of this whole chase that we've had within the overall market. So eventually, if I was a betting man, I would bet on a very big correction in energy stocks at some point to realign with underlying oil prices. Now, again, that's a guess, right? That's just a guess. But we've never seen historically, since XLE came into an existence, this type of a gap in performance between energy stocks and the underlying commodity because they are linked, right? That's where all their revenue comes from. And so if we see another big downturn in oil prices, which we will, if we get into a recession, oil prices are going to fall and energy stocks will eventually have to play catch up. But again, a lot of this push higher in energy stocks, and we're long energy right now. So we have some energy. We have ExxonMobil and Diamondback Energy in our portfolio. The reason we own them is for the yield, because with zero interest rates and what was going on previously, the chase for yield since the pandemic has pushed a lot of money into energy companies. But again, that gap between the input source and the price of the stock is not really sustainable. Now, what causes that correction, what causes that realignment is generally a crash in oil prices. We've seen these kind of deviations before to some degree. You saw it back in 16, 17, 18 in particular. And there was a pretty big gap in between, not as much as it is now, but there was a gap between energy stock performance and oil prices. And then that closed in 2020 when oil prices went negative. So again, I don't know what caused it or when we get there or what happens, but I hope that kind of answers your question. So yeah, I don't know. It's an interesting conundrum, and it's something that I've been kind of watching for a while here. But again, it hasn't really mattered up to this point. And again, we just kind of trade the technicals on these positions. Right now, the technicals are good, and the dividend yields are great. But again, the risk here and a lot of the people that I know that own energy stocks, they go like, I buy ExxonMobil and I never sell it because I just own it for the dividend. ExxonMobil has a very long history of protecting their dividend. It doesn't mean the stock price can't get cut in half. And it has before. So just be careful with your exposures and how you're managing that risk. So again, we'll see that. That brings up kind of a couple other things. So, one of the issues is the fact that we've not had a recession for a while. And this, there's all these indicators, whether it's the inverted yield curve, which is now the longest on record, mind you, of being inverted without a recession. So there's more and more of this debate about recession, no recession, and honestly, nobody knows, right? Right now, there's absolutely nobody that seems to think we're going to have a recession. Sorry to give myself the hiccups. Nobody thinks we're going to have a recession, which is why analysts are getting very optimistic about earnings growth. But all the other economic data is really starting to slow down here, as I said earlier in the show. So again, that risk of recession isn't zero. And a recession would certainly revert commodity prices in general because you have a slowdown in demand. Remember, commodity prices are just a function of supply and demand. And it's accelerated by what happens on the NYMEX. And we went through, if you haven't read the article on the website, I wrote an article 2 weeks ago about commodity prices, and I went through the cycle of what happens with commodity prices. And initially you have a supply-demand imbalance, so prices start to go up. Say, you have a freeze that kills your orange crops, so you have a less supply of oranges. So orange juice prices start going up. Then Wall Street jumps on, starts pushing those prices higher, and it creates a virtual cycle. And then you eventually have the crash. A recession will cause the next crash because as you get into a recession and demand slows, supplies increase, and then Wall Street begins shorting everything. And that causes a big price crash. That's what happened with oil prices in May of 2020. Oil prices went negative in 2020. Now, did the price of a barrel of oil actually go negative? Right? No, it didn't. But the futures contracts did. And that's what we price stuff on. So, that's how the cycles work. So again, volatility is going to be the biggest risk for investors, and eventually some of these more abnormal deviations from long-term trends like technology. NVIDIA surpassed Microsoft, is now the largest market cap weighted stock in the world right now. And that's just been in a massive run-up since October of 2022. October 2022, stock was about $100 a share, right? It ran up to almost 2,000, split 10 for 1, and it's running back up again now that everybody can afford it, right? But eventually something happens, and you have, and as I was talking about earlier in the show during the market wrap, there's this big gap in performance between the equal weighted index and the market cap weighted index. That's unsustainable. At some point, that reversion has to occur. What causes it? Again, an unexpected exogenous event that nobody's talking about. It's, look, and this goes back to the Saudi dollar issue, right? Whenever you're seeing these videos about some macro event that, this is it. This is the one that's going to, destroy everything, right? Get out of everything now and buy gold or whatever their pitch is, right? Buy insurance. It's not it. If they know about it, it's not it. Because if they know about it, so does Wall Street. And Wall Street's already priced it in. What has to be the event that causes this massive economic downturn that everyone's seeing? I don't know why people are hoping for these type of things, but here we are. So what everybody's hoping for is this massive economic downturn
for whatever reason, because it's terrible, right? I mean, it's going to destroy your wealth. It's going to destroy your livelihoods, put you out of business. You're going to get fired from your job. You're going to lose your jobs. I don't know why people are rooting for this type of stuff, but hey, there's always these people out there. But what causes it has to be something nobody's expecting. And the best example we have is really the pandemic and the financial crisis. What caused both of those? Nobody expected the government to come out and shut down the economy. Nobody expected the Federal Reserve to force Lehman into bankruptcy. Those were totally unexpected exogenous events that nobody saw coming, but that's what causes those very sharp downturns. If it is a normal economic slowdown or some event that just weighs on the economy, the markets aren't going to crash. They're going to price it in fairly quickly. Russia, the invasion of Ukraine by Russia, right? Markets were down 20% over the course of a year. That's most likely the downturn you should be looking for. Now, could that unexpected exogenous event show up? Absolutely. But we will have no idea what it is until it happens, because if we did, the markets would already price it in. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will NVIDIA go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. So, just get ready to kind of wrap up the show this morning. There's not a ton of stuff happening between now and the end of the month. Now, the two things that are really kind of going on here more than anything, the drivers of the market. So, if we go back and look at seasonality, the month of June tends to be strong in the first half of the year. Now, again, this is seasonality, so this is averages. Right? So this doesn't mean this happens every single year, but on average, the month of June tends to be a bit stronger at the beginning of the month and weaker at the end of the month. And in fact, most of the gains of June tend to get given up in the last 2 weeks of June. Now we're into the last 2 weeks of June, right? There's 10 days left. We're also wrapping up the end of the quarter, and we're also back in blackout for corporate share buybacks. So there are some headwinds here that suggest that market trade could be a little bit weaker here over the next couple of weeks as we head into the end of the quarter. And as I talked a little bit about yesterday, there's a big rebalancing coming up with XLE as an example that is going to cause some selling to go on with portfolio managers that track the technology index. Now, it's not massive, right? But there's just these things that are kind of occurring. You've removed a major buyer from the market. That's your stock buybacks. They will be fully in blackout by the end of the month. So as we get closer to really about June 25th, we will effectively be fully in blackout for buyback. So that's a buyer that gets removed from the market. Also, we got end of the quarter rebalancing. This has been a very good quarter, right? So a lot of portfolio managers that are, have a 60-40, 80-20, 70-30, whatever their allocation model is, they're going to have to do a rebalance because they're overweight equities, underweight bonds. So they'll have to do a rebalance going into the quarter. Also, just pure equity managers will have to rebalance because they have a lot of that, and particularly with this market, which has been very bifurcated, where we've had just a handful of stocks going up, all of a sudden, my 6 technology stocks are way overweight in my portfolio and everything else is underweight because those haven't really done much. So now I've got to sell my winners to buy the ones that haven't been performing as well over the course of the last 3 months. So we could see some sell. So importantly, going into the end of the month, there's some reasons. And again, not saying this is going to happen. Again, the averages suggest that the end of June tends to be a little bit weaker, but that's just the average. That means that some years were better. We've had Junes that are great. We've had Junes that were absolutely terrible, right? So the average, though, that's what it suggests. And there's some reasons to support that we could have a little bit of weakness, particularly as strong as this market has been in over the last week or so. Anyway, the market's very overbought on a relative strength basis. The deviation from the 50-day moving average is now it's not at record extremes, but it's pretty deviated from the 50-day moving average. And as we've talked about yesterday, that deviation is like gravity. It's eventually going to pull prices back down to it. And so we've kind of got all the ingredients needed. We've got an overbought condition. We're moving a major buyer from the market. We've got a deviation from moving averages. We've kind of got all this stuff in place that would create the conditions necessary for a pullback in the markets, some type of correction. That would take you back to the 20-day moving average or maybe even the 50-day. So a correction back to the 50-day moving average right now would be about 4.5%. So it's not much, right? It's not a big correction. It's going to feel worse than it is because complacency is very high, volatility is very low. Investors are very enthusiastic about equities. So that type of setup, when you do have a correction, it'll be, oh my gosh, this is the big one, right? It says, Elizabeth, this is the big one. I'm coming home. That's old Sanford and Son for you youngsters. They can't even play Sanford and Son anymore because it's not politically correct, right? I mean, but them, Archie Bunker, All in the Family, can't play that anymore. That's definitely not politically correct. It's such good stuff. But that's the way the markets look at it, right? And that's the way it's going to feel. It's going to feel terrible because it's been such a complacent, low volatility market that when a correction comes, it's going to feel a whole lot worse. So just, this is why we consistently talk about just, manage your risk, rebalance your portfolio, take profits when you can, those type of things. Because that way if you do the gardening, right, when the market pulls back, it doesn't hurt as much because you've already done some of the work. And then you can just kind of pull weeds or whatever you need to do during the pullback as needed. But if you kind of do the work in advance, those corrections aren't nearly as painful as they tend to be. So, all right. The interesting article out this morning talking about Ozempic. It's such an interesting story about Ozempic. And so this is all the weight loss drugs, right? This is what's called a GLP-1 is kind of the medical name for these drugs. So this is Ozempic and the other ones that are out there, Moderna or whatever it is. Can't think of the other ones, but there's several out there on these kind of this semaglutide GLP-1 type drugs. And this is to help you lose weight. So you take this drug, and as I've told you before, it makes you absolutely sick to your stomach. Food looks, just the thought of food makes you not want to eat. It just makes you want to throw up. It's like, I don't even want to eat. And so you don't eat, right? And so you wind up losing weight. Well, so this is spurred a very interesting dichotomy within the financial markets, because it is a function of, well, if everybody's going to take this drug, and again, they're trying to move this to the point to where they can deliver this drug over the counter. So you can just go to Walgreens, pick up your semaglutide, and go to the house and, take your, I guess right now it's an injection. So you have to inject yourself. But I'm sure at some point they'll figure out a way to make it a tablet. So you just, swallow a pill or take a tablet and you've got your semaglutide. And so the goal of this has been interesting, because initially it was sell the fast food providers, because if everybody's on these semaglutides, nobody's going to eat fast food. The high prices was pretty much killing the fast food industry. But, this was the other impact. And it's interesting because there was an article talking about the Ozempic fuels the downsize me trend, where Americans are now on the hunt for new clothes. So this is a benefit now for clothes providers. So Abercrombie Fitch, The Gap, etc. Here's the problem with all these stories. So be careful, as always the case. Again, be careful of these headlines, because these are extrapolations. What they're finding is exact what from the studies, right? So they've put people into these test trials, and they've been following groups of people that are taking these GLP-1 drugs. And what they're finding is exactly what you would expect. That GLP-1 is just like a diet. And what happens for most people that go on a diet? They go on a diet, they do really well for a while, they lose weight, and then what happens? They fall off the diet. They go back to doing what they were doing before. Because the diet, and this is the problem with all diets, right? Diets are the worst thing ever for you. They're bad for your health, and they're bad for outcomes. And the problem with diets is typically that you're depriving yourself of something, right? Whatever it is. And then you eventually fall off the diet, and then you start consuming everything again, and you gain all your weight back. The problem with the diet, though, is it never changed your behavior. See, this is the obesity problem is a behavioral problem, and it is a behavioral problem of a variety of issues, and it's linked to emotional distress, to environmental stress, all kinds of other things. But the obesity problem is a behavioral problem. So GLP-1s are great. They're like a diet. And when people get on them, they lose weight, and they're like, oh, this is great. I'm losing weight. But what they're finding is that after the first course of 12, generally these courses are about 12 weeks on average. So you go 12 weeks, and at the end of 12 weeks, then you have to, they reweigh you. They say, where's your, my target was X and I want to be on Y, whatever it is. And so at the end of this 12-week period, they've lost weight. They go out, they buy some new clothes, and then they stop taking the GLP-1s. And then what happens? Your appetite comes back. And when your appetite comes back, what do? You go back to eating more. And all those cravings come back. And so they gain weight again. So again, be careful with these prognostications that GLP-1s are the magic pill that's going to make everybody in the U.S. skinny, and it's going to destroy fast food chains, and all the new clothing companies are going to have all this new revenue. Because as we're now finding out, and as you would expect, the GLP-1 is a diet. And as with most human beings, if we don't change the behavior, we go back to our old ways. All right, wraps up the show for the day. Have a great day. Be back tomorrow. Who's here tomorrow? Richard and Danny? Richard and Danny tomorrow for Financial Fitness Friday. And, of course, Michael Leibowitz will be back next week, so you won't have to put up with me all day on a Thursday. So, anyway, have a great day. Enjoyed you being here, and we'll see you tomorrow on the next edition of The Real Investment Show.